Good afternoon, everybody, and I'd like to extend a very warm welcome to Scaling Up Climate-Related Financial Disclosure. This is a joint event by the Sustainable Stock Exchange Initiative, and a very warm welcome to Anthony Miller for that, and the Carbon Disclosure Standards Board. It's part of London Climate Action Week, and I'd like to welcome all of you to this fantastic event with this brilliant panel. We have Mike replacing Marty, who unfortunately can't be with us at short notice. I'm told Marty's not very well. I'm also told it's nothing we need to be particularly worried about, which is obviously very important at this particular time. And also Shamila, a warm welcome to you too, as well as David. So what I want to do is make sure that this is as interactive as it possibly can be. And just in terms of logistics, all of you will have an opportunity to raise questions, and do please use the chat function to do just that. I'd also like to make sure that we, broadly speaking, keep all the panelists to time. So if I have to interject, I'm sure you will all understand. And the second half of the panel, the first half is the panel discussion. The second half of the session is going to be where we all have a Q&A. So that's, broadly speaking, a bit about the logistics. I would like to just say as well, huge thanks to Anthony and to Mike for the invitation to chair this event. I'm the Chief Responsible Investment Officer at Aviva, and I've worked at Aviva Investors now since 2006, and it's been a privilege to be involved with all of this work since 2008. Anthony, it's been you leading and driving it since that time, and it's been wonderful to watch it evolve for so long. And with this panel, everybody watching gets over 50 years worth of experience, because I know that all of you have been equally involved since the very beginning, but 50 years experience on sustainable stock exchanges, it really is quite something. So I'd also like to just simply add that I'm also on the panel, that is the Task Force for Climate-Related Financial Disclosure, and being part of that work has been an absolute privilege. So I'm going to be weaving that in from time to time. So that's a bit about the logistics, the broad shape of this event, and how you can contribute questions. What I'd like to do is start the panel now, if I may. So I think the first question is to you, Anthony. And what was the auspices of this initiative? How did it come about? What is it that you're hoping to achieve with this work that you're announcing here today? Anthony, over to you.
Thank you very much for that, Steve, and thank you for moderating this panel. We're really pleased to have you here. As you mentioned, you sit on this task force for climate-related financial disclosure. And of course, the work that you and your fellow members of the task force have done is been incredibly important in helping the world to focus on climate disclosure standards and giving them a nearly universally accepted framework to use. Now, for us, in our work with stock exchanges, and we have with us today, of course, two leading exchanges from around the world, so we'll hear directly from them. But just to give you an idea from the United Nations perspective, in our work with stock exchanges, quite often we're focused on the question of adoption and implementation. So if you pass the baton to us from the work that you've done on your task force, the Tcfd task force, now the question is, how can we promote this work? The recommendations that you've come out with, how can we promote those, particularly to companies around the world, listed companies, for them to implement in their reporting practices? So we were approached earlier this year by the CEO of LSE and Mark Carney, who is the UN Special Envoy on climate action and finance. And of course, needs no introduction, I suppose. He's well known in these circles. And asking us to provide some sort of guidance for stock exchanges on adoption and implementation of Tcfd recommendations. So that's what we've begun. We're still in the early days of this project, by the way. We have about 80 members worldwide of our advisory group, but it's still possible to join this. We've had one introductory webinar. We've reviewed a zero draft, which is the first iteration of our draft guidance, but we'll go through two more iterations that are reviewed by the advisory group before we finalize it. And we aim to publish this in June 2021. So we'll make announcements about that exact date. And of course, Mark Carney will carry this into COP26 next year, which is taking place, I think, in October, if I'm not mistaken. I should know this. I work at the UN.
November.
November. There you go. Thanks, Steve. So that is the big overview. One of the things I wanted to say too about this is in our guidance, we focus a lot on what stock exchanges can do to promote adoption and implementation. And a big part of that we also focus on is training activities as well. If you look at the SSE website, where we have a database of all the sustainability activities that stock exchanges engage in around the world, one of the #1 things that they're engaged in is training market participants around a number of factors related to ESG. And this is a big part of this is ESG disclosure, and particularly climate disclosure. So we're aware of that, and we want to bake that into this guidance right from day one. So that's kind of a general overview of how we got started and what we're doing in our timeline.
Thank you, Anthony. Just as a little aside, a few weeks ago, I did a little countdown on my iPhone, and it is 349 days, 18 hours and 53 minutes to go until the beginning of COP26. So we have 349 days to make the most that we possibly can out of the ambition that was set out to mobilize markets, to make sure that we harness some kind of financial plan, vision and process to the political vision, plan and process that the COP21, the Paris Agreement, contains. So I'm going to bring in Shamila now, and Shamila, we've worked together for a long time, and it's not immediately obvious to everybody, perhaps, why stock exchanges are so incredibly important. I don't think everybody will understand how their money goes through perhaps a pension scheme that uses trustees to then employ an investment consultant to choose a fund manager, and we will then buy and sell securities often listed on exchanges that were then brought to the market by an investment bank, and it's then where the money goes to work. But you are absolutely, stock exchanges are central to the whole market structure, and indeed they were foundational in 1802 when the London Stock Exchange was originally created. The exchanges are hugely important as a convening marketplace, not just metaphorically now electronically, but literally over the last few hundred years. So Shamila, I absolutely understand why exchanges are so important to the overall market, but for you, what's important about this new initiative, and what is it that the Johannesburg Stock Exchange is, having led for so long, since the early part of the century in this area, what is it that you're looking to do here?
Thank you very much, Stephen. Always great to be with you. It's an honor to be here today. And I'm listening to you speaking, and just personally for me, it's always quite interesting because, you know, a few years ago, you actually supervised my dissertation in my studies. So it's quite interesting to be back full circle here, and we're both in the same space, which is fascinating, and I think really encouraging for me. So it's great to be here. In the JSE, I mean, I just reflected recently, celebrated its 133rd birthday. So I myself didn't realize just how old the exchange was, but goes back again, you know, to taking us back to the core function of exchanges, and you've outlined some of that quite clearly. But if I think about the fact that, you know, the report quite clearly outlines for us that financial markets are tasked with effectively pricing risk to ensure this informed and efficient capital allocation decisions. And so what role does an exchange play? And it's at the heart of that exchange, right, of capital allocation and allowing money to ultimately go to where it's needed the most. So let me reflect very quickly then on the markets and prices and what that actually means. And we're seeing, you know, environmental policy and regulation advance, scientific data providing great understanding of climate change and business operations, or greater, should I say, because we're still sitting in a situation where often some of these risks are not understood. And then the flip side, the opportunities are not necessarily always that well understood, but we need to look at some of the financial risks that are emerging. So a few that I think are particularly pertinent to exchanges, to the markets, and to all of us ultimately, whose pensions are largely invested in this environment, come to bear. So let me look at three. I want to look at the renewed policy and regulation. We want to look at some of those changing investment trends and understand what those are. So let me unpack those very quickly. If we look at changing policy and regulation, in 2019, the Principles for Responsible Investment had a white paper highlighting the dramatic increase in attention paid by many financial policymakers, 62 in that report to be exact, to sustainability issues in recent years. And they're talking about what they call the inevitable policy response, and saying that if we don't act quickly, we run the risk of facing quick and knee-jerk reactions and shocks to the market and the systems. And all of us know that this doesn't bode well for us in terms of investment and looking at the longevity of those investments. So the need to understand now what that means, the need to enable better pricing of risk through the role that exchanges can play. And those roles, that role is multifaceted. It does depend on the jurisdiction that the exchange exists in, and also on the nature of its structure, whether it plays some kind of regulatory role, and whether it's disclosure, whether it's guidance or what it does, or whether it's pricing. And so that can play out in different ways. But understanding that this is what can happen to the market is relevant irrespective of the role that the exchange plays in that market. So the policy and regulation side is one side to look at. If we look at the Network for Greening the Financial System, that explicitly recognizes climate risks are relevant to the supervisory mandate and has challenged 71 policymakers and other central banks and supervisors to act to limit the catastrophic impact. So if the central banks are involved and the policymakers are involved, then of course exchanges should be paying attention to what this means and why it's systemically important. Let's look very quickly then at the changing investment trends. So the World Energy Outlook special briefing for the COP21, so COP26, COP21, we're already looking at a good few years ago, estimated our climate change to put at risk total global stock manageable assets of between 4.2 trillion and 43 trillion. Through to the end of the century. And I'm sure that number by now has increased as more and more data becomes available and as we start understanding the risks better. So the investment trends are going to change around that. And as we start seeing this, it's going to start becoming priced into the markets, and in many cases already have been. So some of the studies are suggesting that things like divestment strategies, where investors will start moving assets into different classes, may not themselves be sufficient to avert the climate-related risks. So as a result, both investors and issuers need to adapt to this longer-term impact and understanding that, creating efficiency and understanding what risk-adjusted returns look like. So with that, of course, the disruption of industrial systems and broad economic sectors comes into play. If we're going to look at achieving the Paris Agreement, the way we're doing business now, the way we operate now, clearly is not going to work. The sectors at risk, energy, transportation, utilities, and some certain retail services as well, are obviously at risk. All of these are often listed on our exchanges. These different sectors face different risks. But I think the flip side also, Steve, is the opportunity. So applying your mind to understanding it is the best place to start. And that is really what we're hoping to do through engagement with this work, is get that into the markets and to understand that in the different ways as appropriate for the exchanges. I'll hand back to you.
Thank you, Shamila. Now, you talked about applying our mind to the challenge here. And a few years ago, we started producing our own Tcfd reports as an insurance company. And David will remember vividly, I'm sure, that part of the calibration for our Tcfd report was what's the benchmark? What's the implied temperature change in the benchmark? And one of the scariest statistics I've learned in the last few years was 3.8 degrees of implied temperature change, depending on this methodology and taking it as kind of precisely wrong, but broadly right as a figure. 3.8 degrees is the benchmark. Now, if that's business as usual, and that's arguably contemporary, and certainly post the Paris Agreement, we need to be extraordinarily worried, because at 4 degrees, our business model starts to collapse. And at 6 degrees by the end of the century, which is plausible, unlikely, but plausible, depending on how the runaway feedback loops hit, 43 trillion would be wiped off the stock of capital, and that's the present value. So this is not just an environmental issue. Of course, this is an environmental issue that has huge financial consequences, not just economic ones, to people's pension savings and investments. And at a certain point, if it tests the insurance business model, then civilization itself might start to unwind too. And that is not hyperbole. That is actually ridiculously, that is business as usual, which is something we should all be worried about. And David, I know it's an area you've worked on for a long time. I think I'm right in saying the best part of 2 decades, if not just a bit more. So in your work at the London Stock Exchange, how is this guidance going to help other exchanges, and how does it relate to the model guidance that you very brilliantly chaired and brought forwards in 2015? Over to you, David.
Thanks, Steve. I mean, so I think you set out the rationale here, in that there's a colossal effort that's required across capital markets globally here, and the good news is that investors are taking action. Increasingly, the largest asset owners are wanting to take action. But one of the challenges is poor quality data. And the data needs to really improve globally here. And we feel this kind of quite acutely, given the kind of the mix of our businesses. On one hand, we've got the FTSE Russell, our information services division providing a lot of the analytics and the benchmarks to help. On the other hand, we've got the capital markets part of the business where the exchanges reside, where we're trying to help issuers navigate a lot of this. And so, as you say, sitting kind of between investors and issuers, exchanges have got an incredible role to play here. And so, linking it up back to the work that we did previously with the ESG model guidance, that I think was a very successful project, and it was great that Stock Exchange Initiative pushed this, because this was a way to be able to start off getting exchanges to work together to promote ESG reporting across each of their markets. But the one thing we had to hold back from there was getting too specific on the metrics. So we were very clear on the principles about high quality reporting, but we didn't come down on the detail. We weren't prescriptive on what we recommended. And that's different here. So climate is important for two reasons. One, just that sheer urgency we've been talking about and the need for action. But secondly, the fact that actually we've got a consistent framework to use here. We've got Tcfd, which gives us a framework where all exchanges can work together to promote better Tcfd reporting. We can also interlink some of the kind of more recent developments and things like taxonomies, which I see as a great way to define low carbon products and services. Tcfd doesn't provide a definition set there. Taxonomies do. But importantly, this is about exchanges collaborating, coming together and driving at speed better climate reporting across each of their markets. And there's all sorts of other interrelated initiatives going on. Obviously, we've got IOSCO, IFRS now getting engaged, which is fantastic. But exchanges can act more quickly, and also are engaged in a whole load of regulatory and policy discussions. As Shamila said, each exchange has got a slightly different role here. But certainly what we can do is make sure that the issuers are interpreting regulation as it emerges in a way that isn't kind of boilerplate reporting, but that is giving investors what they need and is joined up with these other initiatives. So what we're trying to do here is by June come up with the guidance, model guidance, which each exchange can then replicate for their own markets ahead of COP26. So ahead of COP26, as many exchanges as possible have gone out, very clear guidance, consistent and comparable, and we've got that, and exchanges are able to help drive that kind of global alignment of reporting.
David, thank you. That's very clear. While you were speaking, Madison Stern raised a question which is possibly absolutely fundamental here to what it is that you're trying to achieve. So before we move on, I just want to bring this question in. She's asking, how do you ensure that we achieve consistent ESG information on all exchanges? And presumably, this is precisely how you ensure it. The whole point of this process is to do just that. Is that a correct assumption? You're nodding.
Exactly. On two levels. Firstly, the whole point is we're trying to come up with a model guidance which each exchange can use as a basis for their own guidance. And we're drawing from Tcfd here as well. We're also trying to make this really accessible for all issuers. But also exchanges will be plugged into other policy engagements across, in their own markets. Some will actually be regulators in their own right. And this is the whole point, is trying to drive consistency. So that's what we're after.
It's guidance. And in the sense, the more likely, if you produce this soon, the more likely it is that everyone else will follow suit, and then you'll end up with a more harmonized approach than would otherwise be the case. It's clearly not regulatory. It's not something that can be mandated. That's not the point of the UN, but it provides something, in due course, a regulator interested in this could have regard to the guidance in coming up with their own framework. And Madison has just thanked you for your answer there. So David, thank you very much. Much appreciated. Now, Michael, thank you, as I said at the beginning, for standing in for Mardi. It's enormously appreciated, but I know that you and she have worked together for a long time, and you've been part of all the various briefings for this session. So I know that CDSB, we've heard Shamila talk about the inevitable policy response, and the CDSB itself has been trying to drive that too, because it's only inevitable after a collapse. Ideally, we want it to happen well before any kind of environmental collapse. So you've been doing an enormous amount of training and technical assistance, and in the draft report, there's a heavy emphasis on that. Could you just give everybody on the webinar a bit of a better understanding of what it is CDSB does at the moment to assist the market? Mike, over to you.
Thank you, Stephen, and thank you everyone for joining us today as well from my side. Indeed, we've been quite busy working on training. We think that information and knowledge are a key lever in creating lasting change throughout the market. And just for those of you who are not familiar with CDSB, the Climate Disclosure Standards Board is a consortium of 9 business and environmental NGOs, and our mission is really to integrate environmental, including climate change related information into the mainstream reports, the annual reports of companies, also learning from financial and so-called non-financial reporting. So if you hear that, you might think that sounds an awful lot like the Tcfd, and I would agree with you. And so in the past 2 years, we've been told that we're quite bad at promoting our own work, because we have really found the Tcfd recommendations such a force for good that we decided to get behind that and use that as a way to achieve our joint mission. And so what we have done as a beginning is we have, on behalf of the task force and working with the secretariats, produced the Tcfd Knowledge Hub, which is an excellent resource. If you haven't been there, I strongly encourage you to visit it. It's a search engine essentially for all the resources that are out there, that are available already out there in the market, to help you implement the Tcfd recommendations. So if you are let's say a UK-based financial services company, you might be able to filter by that and find the resources that are available on scenario analysis, let's say. Beyond that, we have also created a whole range of online learning courses on this platform, and that have been very, very popular recently, especially given that we aren't able to meet in person. So we are seeing hundreds of course completions a month, training up thousands of professionals throughout the investment chain, and we're very proud of that. It's become a very good way of getting those practical basics through to the market. Beyond that, we have, when there isn't a global pandemic going around, we do like to lock ourselves in a room with a group of issuers, report preparers, and also their investors or lenders, and go through the basics, go through the specifics, and really walk through the entire journey with them. Now, this is where the stock exchanges come in as a really powerful ally, because they are the center of the market. They are the ones that bring everyone together. And so we've found it very, very helpful to partner with exchanges in providing some of this training. So this has been an extremely helpful partnership, and we hope that we are able to do more of that. And in this respect, I hope this is a good time to announce that we have been very, very happy to be working with the Sustainable Stock Exchange for what feels like almost a decade in the best possible way. And we have really enjoyed our partnership with this Sustainable Stock Exchange initiative. But today we'd like to go a step further and formalize our collaboration, especially around training, working together to support the markets and the exchanges that host those markets to train up both the issuers and also, of course, the users of this information. So today we're happy to announce this exchange of letters. We joked about having a virtual handover of the letters. Unfortunately, we aren't able to join and sign, but we are formalizing this agreement, and we're very much looking forward to working together. This guidance that is going to be developed is going to be an excellent tool to do that. It's the previous guidance that was mentioned as well. The documents that the Sustainable Stock Exchange Initiative develops, and Anthony, I'm going to quote you. it's a sort of a menu of options and choices that an exchange has, and every exchange had its own circumstance. And what's really great about these toolkits that the initiative produces is that it is so flexible and is usable. And we have as CDSB, of course, produced further guidance, be that, for example, with the various reporting initiatives such as SASB or CDP, on how to use those and our framework together to implement the Tcfd recommendations. We've produced checklists, but it's all meaningless unless it's out there in the market. And we have really found this partnership useful, and very much looking forward to further collaboration in this space as well. Back to you, Steve.
Thank you, Michael. You've been very clear from your perspective, from CDSB's perspective, about why you found the collaboration with SSE useful and important. Anthony, I'm going to come to you in a second. If you can reflect equally in return about why it's so important to you as SSE to be collaborating with CDSB. And Michael, you said it feels like a decade, because it has been a decade. We've been working together for a long time now, and I'm so pleased at the traction it's got. It is clearly the case that the quality of disclosure is significantly better. The comparability has improved. It's not brilliant, but you mentioned as well, Michael, that the TCFD was almost filling a role that you've been set up to play. And I think what the TCFD has done is kind of brought it further into the official sector, prepared guidance that's regulatory ready, and given it an FSB imprimatur with an industry leadership behind it. But it definitely was based on the thought leadership that CDSB and others had laid in front, the carbon disclosure metrics as well, that CDP had produced alongside CDSB, and then there's a global reporting initiative and the Sustainability Accounting Standards Board. This whole milieu has been very, very helpful from the broader TCFD perspective. And I speak as a member of the task force. So we stood on your shoulders, if you like. Anthony, back to you then. From an SSE perspective, and of course you work at the UN, and the Conference on Trade and Development has been around for now over 4 decades and has done brilliant stuff, whether it's ISAR here for the Sustainable Stock Exchange Initiative or elsewhere. Working with CDSB, I know, is incredibly important to you, but precisely why? And how is it that it's going to make a big impact?
Thanks for that, Steve. And just to echo Mike's comments, that we are, of course, very pleased to have this exchange of letters and to announce our deepening collaboration around training for exchanges. At the SSE, our mission is to help exchanges, to assist exchanges in their efforts to promote corporate sustainability in the marketplace. And to promote sustainable finance and investment in sustainable development. In doing that, we're always trying to connect the dots and bring together the world's experts on specific subjects who can assist exchanges on various aspects of this quite broad-based mission. I mean, we've seen some of the comments in the comment area about the broader nature of ESG, and that's absolutely correct. And so we, at the SSE, we partner with a number of organizations around the world that we think can bring world-class expertise to exchanges and to assist them in that mission. And of course, CDSB is one of the leading organizations when it comes to climate disclosure. And we have a history of collaboration in various events that we've done with exchanges around the world. So we're looking forward to deepening that relationship. This is, as I'm sure, Steve, you've told many people yourself on these occasions, but I think it's useful to remember, we're in 2020. This is the decade of action. We've got 10 years to deliver on the Sustainable Development Goals. Particularly if we look at climate disclosure, it is, and ESG disclosure more broadly, it is a very realistic and achievable objective that we have most companies in the world delivering some sort of uniform or at least aligned reports by the end of this decade. But that's not going to happen without a tremendous amount of effort. And even where we have exchanges doing their part and they're promoting these standards, and even where we have issuers doing their part saying we would like to prepare these reports, then there comes that part where the rubber meets the road, so to speak, and you have to really get into the nitty-gritty. How do you prepare these reports? And that's where we're always happy to lean on our friends at CDSB for the actual technical details of how you do this work. And let's remember that this is going to be an ongoing conversation. It's not as if we educate everybody on how to produce these reports and then, for the rest of the next few decades, everybody just goes along doing it. If we draw the analysis to financial reporting, it is an ongoing education. All financial accountants are constantly upgrading their knowledge in this space because things do change and evolve, and that is normal and inevitable. So I think this is something that we look forward to collaborating on with CDSB, as well as, of course, our obvious partners, the stock exchanges. I started out earlier by saying that stock exchanges around the world, one of the leading activities they engage in is market education. And many of them, it's a broad range of activities, including financial reporting and so on, but ESG reporting and many other types of ESG analysis and issues are integrated into their market education programs. And so we're happy to support exchanges in that, providing them technical expertise where we can and content for their training programs. So that's a bit about what we're looking forward to and what we're hoping to get out of this partnership. And I'm sure we will get that because we've worked together in the past and we have a good foundation to build on.
Thank you, Anthony. Now, I'm conscious that there's been a load of questions coming in and we're all working through them. I can see heads down in a number of occasions where people are reading the WhatsApp back chat as well as looking at the chat on the screen to make sure we're trying to coordinate things. So thank you all for reading them and for reflecting on them as well. There's a few complicated ones in there, like does anyone know about HR 4329, which I've got to be honest is a new. I know a lot of abbreviations, but that set of numbers and that abbreviation is new on me. So if any of you wish to answer that question, feel free. But the one that that just grabbed my attention was from Lynn Johansson. And Lynn asks, has any of us thought about how digital finance enables the democratization of markets? And if it's okay with you, I'm going to say a few words myself and then open it up to the panel to reflect on what I've said and offer their own views too. So this is speaking now from an Aviva investor's perspective rather than a sustainable stock exchange perspective. But I mentioned earlier that stock exchanges were created hundreds of years ago. And in many markets, they were part of a government, they were not-for-profit. They have obviously evolved an enormous amount in the last few hundred years. And part of how they've evolved is, I remember being told how people would go into the London Stock Exchange, for example, the physical building, they'd have cash in their pockets. They'd walk out with share certificates. Those share certificates would go in a safe or under a mattress. And they knew what they owned. The kind of the transaction frequency was far less rapid than it is now. And the markets have evolved so much that I think it's fair to say that in many markets, and I know the UK is one of them, the average pensioner has very little understanding of where their pension is invested or even that it is invested. If we're honest, the auto enrollment in the UK has led to a lot of people just expecting this all to be looked after for them. So for those though that realize that markets operate in the way that they do, it used to be that the people knew what they owned. That's no longer the case. And we need to, firstly, using digital finance, reconnect people with their money. So imagine an app in a phone, which has your pension, then has what it owns, has how all of that is performing financially, and then has the voting record of your votes at company AGMs historically, and also gives you some guidance of how those companies are performing in relation to the Sustainable Development Goals. And then allows you to engage with those that do vote your shares, if it's not you owning them personally, they're owned on your behalf and run on your behalf, allows you to engage. Now, there is an app that has been built by an organization called Tumalo, and we've had a few pilots, beta test pilots with a few of our clients. And one of them, every single staff member used it, which is obviously incredible for an app. Now, it was a particular kind of organization. I can't say who it was, but you would expect more of them than normal to engage. But for everyone to use it as a system, it's reacquainting people with what they own. It's giving them voice, and it's allowing them to vote with their vote before they vote with their feet. And Shamila, you mentioned divestment, and I personally remain deeply unconvinced that it achieves anything. I recall the apartheid movement, and I remember the divestment campaigns. It didn't really change. There's no evidence it changed the cost of capital of any company, but it did change the political environment. So I think what we need isn't people walking away. You need those that understand the problem and care about it most to be permanent, or not, if not necessarily, but I'm going to change that. They need to be active owners and potentially walk away if the company does not respond in a reasonable time frame. So that's my response to Lynn's question on how you use digital finance to re-democratize markets, and has the Sustainable Stock Exchange thought about that? So of course, if there was a vote on a climate change report at company AGMs, which is looking more plausible now, then you can, Tumelo is the name of the organization building the app for the question that just came in. So does anyone want to add anything to what I've just said from the perspective of their own institutions and how we use the sustainable stock exchange work to kind of re-democratize markets to a way they used to be when they were first created? Anyone wants to put their hand up? Then, thank you, Shamila. I will please do add to what I've said.
Thank you, Steve. My reflection is more on the impact of digitization more broadly than particularly this. And it is predominantly because of the democratization of information, the ability to make that available and for people to use that more speedily and in different ways. And I think that's the biggest impact that we have right now, where it filters into things like how that works in financial markets, the availability of the information. You know, there are many, many use cases for that. But my particular reflection is if I consider where I'm sitting and the part of the world I come from, and the kind of issues we have around inclusion, around financial education, around financial inclusion in particular, one understands that this issue of the democratization of information and the increase of accessibility becomes a very powerful tool. I reflect back quickly on, I think it was the Kenyan case a few years ago, where the Kenyan government issued a sovereign bond, a retail bond, using digitization, using apps and things like that to make that available to millions of Kenyan citizens on their phone with new technology, with different ways to do that, and enable them to participate directly in what the government was doing. Now, cut and paste for green bonds, social bonds, and the like, for the information sharing that could happen in that regard. And you can see an entire shift that potentially could be premised on digitization and from this process of access to information and what it allows for millions of people who've been marginalized. So I think that's a point I wanted to reflect on. And if you add that to what we're seeing is increasing trends, and we speak about the millennials and the impact that they have ad nauseum sometime, but that's exactly what's promoting that in many instances, is that they have that information available, they're able to do that quickly, and they're able to vote with their feet, they're able to change perceptions with the trends and the influences that they have. And I think that's something we need to pay attention to, because once we see investor demand shift at scale and that grassroots movement, we're going to see that impact across the market.
Thank you, Shamila. We've had a number of, you talked there about millions that have been disenfranchised. And I think that there have been a number of questions that have come in from the chat already on the social side of things. One particularly, I think I'd like to direct to you, if I may, Shamila, from Premal Ranchad, which is around the role for Africa in a conversation that's often dominated by developed countries. What's the role for Africa? And I'm acutely aware of this myself, and it's often struck me that the developed markets is where the money is, but it's often the case where developing markets, developing economies, developing countries, the most significant environmental bang for buck is investing in those spaces, but the benchmarks don't facilitate that transaction. So what I see our role here is in trying to square that circle and make sure that international flows of money into developing markets are facilitated at scale, and therefore the environmental as well as financial impacts are optimized socially and environmentally. But getting that conversation to be enfranchised is very hard. Shamila, you're here representing, if you like, the African continent. Can I ask you to reflect on that question and say what else we could do collectively to deliver more for that?
Thanks, Steve. So I'd be a bit careful about representing the entire continent.
Indeed.
But I think a few reflections on what Premal has said. And by the way, hi Premal. Premal is from South Africa, from one of our largest asset managers. So nice to see him on the call today. So Africa, if I reflect on a few things, let's consider the process of COP. And we consider how those negotiations have happened and developed over a number of years. And that's particularly where a significant role has developed for the continent. Initially, countries are negotiated on their own. When Africa came together as a bloc, we started to see change into the increasing recognition of the issues that were faced by the continent. And I think that gives us one powerful signal, that we need to consider that the continent has to have a strong voice, and how it brings together that voice is very important. If we consider the fact also that particularly in relation to climate change, we know that the continent faces an increased burden as a consequence of global warming. So whatever the average temperature increase is going to be, this continent would face anything between 2 and 6 degrees higher than the global average temperature change. So even at 1.5 degrees, 2 to 6 degrees higher is a serious concern for this continent. It's still a continent that's largely agricultural. We know what changing weather patterns mean for agriculture. So if we consider those issues, the need for Africa to be able to consider itself differently and be able to have a stronger voice is important. The other thing, the youth premium. In a world where largely many of the developing economies are facing aging populations, a lot of your workforce is potentially going to come from those parts of the world that have a younger population. Africa is top of mind in that regard. It needs to consider this and the demographic dividend that it can generate, but also what it has to offer the world from that perspective. And it needs to, I think we need to be able to be more vocal about that. The world needs to understand that that youth population needs to be educated. It needs to be contributing to the global goals that we have and will be fundamental to some of the economic decisions that are required and some of the financial implications. So when I think about it from that perspective, those are the things I would like to see coming to the heart of investors considering the continent, knowing where those opportunities lie. And of course, you know, it's wide open for investment to be able to actually actualize on some of the returns that one could see if we use that lens of understanding the demographic dividend, understanding some of the consequences of climate change potentially. What happens when you have huge amounts of refugees from the continent needing to enter other countries? You know, suddenly what Africa faces becomes a challenge for everybody, but potentially a huge opportunity. So I hope that that gives some reflection, Steve. I mean, it's a massive topic we could spend days on, but those are some of the key ones for me that are very important to understand.
Shamila, thank you, and an excellent question as well. Thank you from me to the questioner. I'd like to move on to some of the other questions now, and of course, if other panelists, and I know you have been reading the questions too, there are quite a number that haven't yet been addressed. So I'd like to make sure that we have as much chance to do that. But perhaps one of the most important questions is, how are we going to measure success? And I think that does start to pick apart some of the other questions that are on there. For example, the ones about impact and action. And this is all well and good having the guidance, but what action is it going to motivate? And I remember the kind of the management euphemism that you manage what you measure. Then there was the inclusive capitalism movement that added to that with you treasure what you measure. And of course, if you measure it and you manage it and you treasure it, then you're much more likely to conserve it, take action, and of course can be held to account publicly by investors and stakeholders beyond. So obviously disclosure isn't just for disclosure's sake, it's to mobilize action on climate to reduce the types of climate change that Shamila was referring to just there. That for me is the whole point. But for me, that doesn't make it easy to measure impact. So Anthony and Michael, how are you both proposing institutionally to measure the impact of this guidance, recognizing that that is a very difficult question? Who would like to go first?
Can jump in there, Steve. Thanks for that question. And that is something we ask ourselves at the beginning of this project. And Dave and Shamila will know we've had a lot of internal conversations about that. Let me start out by saying that when it comes to climate change, there's only one metric that matters at all, and that is the parts per million concentration of CO2 in the atmosphere. Everything else is everything else. So let's keep that in mind. And of course, we're all looking at a sort of science-led approach to climate change. That said, now as we work backwards from that one all-important metric to our world, our corner of the universe, which is stock exchanges and finance, we have to say, what can we do in this space? You mentioned at the beginning of this call that David Harris was the chair of our advisory group for our model guidance, the SSE model guidance on ESG disclosure, which we launched in 2015. At the time that we launched that guidance, there were only 14 exchanges in the world that had any kind of guidance on sustainability reporting. When we launched that guidance in 2015 at the London Stock Exchange, we also launched a global campaign challenging all of our members of the SSE to introduce guidance on ESG disclosure. And in the last 5 years, we've gone from 14 exchanges with guidance to 55 exchanges with guidance. So you've seen more than a tripling. And so now we're more than half the exchanges in the world have some sort of guidance on sustainability reporting. And many of these exchanges are already on version 2.0. So they're moving quite rapidly forward. What would we like to see in this space? We'd like to see a deepening of guidance around environmental reporting with specific focus on the recommendations of the Tcfd task force. And beyond that, of course, the ultimate impact of the exchanges in this space is to carry their issuers forward. So the SSE has done some work on that in the past, where we have looked at the ESG disclosure practices of the issuers of exchanges. I think we'll do that in the future, where we'll start looking at the environmental reporting practices of issuers from different exchanges, and particularly whether or not they're following the recommendations of TCFD to get a sense of the quality of this reporting. And of course, working with exchanges who are having a difficult time bringing their issuers on, then we'll bring in our partners at CDSB and others to help to move the needle on that. I think that is the metric that we're after. Of course, it's an interim metric. The ultimate metric is parts per million in the atmosphere, but that's our interim metric that we're after, is how many of these companies can we get producing high quality reports on climate disclosure.
Thank you, Anthony. Michael, did you want to add anything to what Michael said, or has he answered for you too?
He's done a pretty good job. I would just add to that one additional metric, and I agree with you. Parts per million when it comes to climate change, emissions numbers are the ones that matter. Another metric below that is also money. We need money to make this happen, and so what we are always interested in seeing is how this information is influencing investor behavior, how decision useful this information is. And so our very pragmatic way of doing that is actually looking at those reports, and the team here at CDSB spent an awful amount of time actually reading through companies' reports and seeing whether those work. This needs to be done, of course, in close consultation with the investment world, and then we need to have an open conversation to make sure that whatever we're pushing for, whatever we're trying to create, is actually what the investment world needs. And I would also like to sort of comment on the point around impact. And we also need to understand what this is, what the TCFD is, and what it isn't. And that's all right. It's not a silver bullet. It is an incredibly important lever for change. But the ecosystem is much larger, and market mechanics are market mechanics, and efficient markets are what they are. So we also need to look at the broader context and make sure that the flow of money is also in line with our wider sustainable development goals and Paris Agreement, et cetera, et cetera. So there's reporting is an incredibly influential infrastructure. It's often seen as the basis, the foundation on which all of this works. But then we need to react to that information, be that as an investor, be that as a government, be that whoever else is in power to make this change a reality.
Thank you, Michael. I'm just going to reflect a little bit on Anthony's point on parts per million there, and then what you were saying about efficient markets being as they are. I just want to give everybody who's watching who might not be as steeped in this stuff as maybe this whole panel a bit of a flavor about what that actually means. And then just to give you all a heads up, Raymond Philippe has asked a lot of questions here about the gap between investors and asset operators, not asset managers, asset operators. And that is a really important distinction that often gets overlooked in the kind of real asset part of the investment chain, as opposed to the equity chain. So I'm going to ask for contributions if any of you wish to. And he also goes on to talk a bit in other questions about the majority of the reporting being on historic emissions and historic performance. That's unsurprising. But how do we look at evaluating future ESG results? So to give you all a heads up that's where we're going next. On Anthony's point about parts per million, when Aviva was created in 1696, parts per million weren't well measured, but it was around about 250, 260 parts per million of CO2 in the atmosphere at that point. It's said that we've now breached about 410, and the vast majority of that change is anthropogenic, it's human produced. And the UN Framework Convention on Climate Change has the International Panel on Climate Change, the group of roughly 1,500 scientists who've all been asked to opine on, is that anthropogenic? And their answer is yes, in a series of very long, very thoughtful, very well referenced reports. They are almost 100% certain that it is, and any residual doubt is only because of that's the way that science works. So they're as sure as they can be that it's anthropogenic. I think one of the other scary facts, and this isn't well publicized, but if the entire proven and probable reserves of the oil and gas sector were burnt, if they were, then we would get to over 1,000 parts per million of CO2 in the atmosphere. Some would say over 1,200. That bit of the science is less credible, but is certainly scary, particularly when you consider that it's 450 parts per million of CO2 that is felt to be the tipping point, beyond which it gets harder and harder to manage a transition back to where we need to be, a just transition back. So it's interesting to just consider that business as usual today is still 3.8 degrees. And if we hit that temperature change, that's not static. It's likely to cause other feedback loops that continue as far further and far faster beyond that into next century and beyond. And as a business that's been around 320 years and has seen population grow from about 300 million to nearer 8 billion today, and global economies grow 800 times, not 800%, there's an enormous amount of change that we've witnessed, and that we certainly don't want to see the change where there is 1,100 parts per million of CO2 in the atmosphere. So the question is now, how do we harness markets to the Paris Agreement? How do we use money to drive the transition that we need on a just basis? And we're only just beginning to address that. What's the role of credit rating agencies, asset owners, asset managers, regulators, particularly now that it looks like we've got a Biden administration coming in? The multilateral system and the international regulatory system has been held back, in my view, by the US. It will now hopefully be unfettered in a way that we can see what a lot of them want to do, IOSCO, IASB, FSB, and elsewhere. They should now be released with a lot of the NGFS, the Network for Greening the Financial System thinking that Shamin has referred to. There's also, just to capture, Michael, your point around how efficient markets are, there are many different markets. Hardly any of them are perfectly efficient, even though that's the standard economic assumption. I want to just highlight that conventional finance discounts the future at about maybe 7%, maybe more. And that means that these massive hits towards the end of the century, where physical risk does get catastrophic, get discounted to near nothing today. Even a trillion hit to somebody at the end of the century is only worth a few hundred million today. That's the tyranny of discounting working backwards, just as it can work for you with a pension scheme. So markets discount the future, and that doesn't help when it just transition has intergenerational equity at its heart. And that's not just true for valuation and stock exchanges and how the pricing, it's also true of risk, because we discount risks in the future too. So there's only so much you can achieve with reporting and risk monitoring and valuation. It needs, what we fundamentally need is, I think, greater harnessing of the markets by governments recognizing that markets themselves are myopic and there is a tragedy of horizon, as Mark Carney has said many times. So that was a few minutes from me. I mentioned that we should respond to Raymond Philippe's questions about asset operators and then this point around vision and scenarios going forwards. Do any of you want to reflect on Raymond's questions there? David, thank you for putting your hand up. Over to you.
So we need to kind of join up the systems from issuers through to asset owners and to individual investors, as we've been discussing. And what's the language, what's the information flow, what's the engagement across the entire marketplace that can achieve that? And I mean, to bring it back to this work, that's what this is the fabric of that. This is what we're trying to achieve here through Tcfd. And I think actually this has provided actually a kind of a core underpinning for so many other things. I know part of that question was about the plethora of different initiatives and how they link together. So to provide some examples, Tcfd forms the basis of the if we look at the Transition Pathway Initiative, TPI. It has a management quality score and it has a carbon performance assessment. For the management quality score, it's driven by Tcfd data points, and that's trying to put companies on a scale depending on how credible their climate strategies are. And that TPI itself feeds into Climate Action 100+, the world's largest ever collaborative investor engagement initiative. Over 50 trillion in assets behind that. Again, so Tcfd is forming a core underpinning for that. the institutions of climate change have just come up. They're consulting on their framework for net zero investing. That's very interlinked with this as well, and TCFD is a core underpinning for that. That also, I wanted to come on to the kind of the target, the forward trajectory bit, rather than just looking at historically. TCFD is about forward trajectory as well, and is about target setting. And in fact, actually, Anthony, Shamir, and I have all been talking also about the importance for the model guidance having a section focused on target setting. And this is an area where there's quite a lot of different evolution going on currently. There are some, there's a lot of work looking at what do we need in terms of sector decarbonisation, industry by industry, and then therefore what does, what kind of target setting is credible here. And to bring it back also to the science points, we do need to stay underneath 2 degrees of warming. It wasn't a kind of just this kind of number created. Beyond that, we get into serious feedback loops that are very difficult to get out of, and then you're effectively on an escalator. We've got to stay under there, and therefore the efforts around target setting and what actually achieves that so-called net zero by 2050, potentially earlier as well, if we're really wanting to try and achieve 1.5 degrees. But so TCFD encompasses that. There is additional work going on in a range of areas, which adds further detail to this. And to the extent we can, we'll capture a lot of that within the model guidance. And I know the other exchanges, when we had the first working group very keen that we captured that. But it will also continue to evolve in some of that detail as we go forward.
David, thank you very much for taking Raymond's questions there and answering them so eloquently. Now, I'm conscious of the time. There's only 3 minutes left. Now, I know you asked me to sum up and have a few minutes at the end, but I've really woven my comments throughout. So what I'd like to do, I know a lot of you have read, I know you've all read the chat, and we've tried to answer as many questions as we could. But if any of you have got a burning answer to one of the questions that is yet to be addressed, what would that be? And I'm particularly interested in Colleen's question earlier, that was the first one that came in. Colleen mentioned that she'd been working with lots of people within, I think, her exchange, looking to see opportunities to get more involved. How do you spot, as an exchange, opportunities to collaborate on this international stage? So that question, Anthony put his hand up first. So to you, Anthony, and then if any of so quickly, Anthony, and then others quickly, if there are any other answers.
I'll treat this as a lightning round. How to get involved from a stock exchange perspective. If you want to get involved, please reach out to us. You can find our contact details on the SSE website. We run a number of work streams. For the climate work stream, it's still possible to join if your exchange is not already joined, so we're happy to do that. Steve, I'd like to get back into the chat. There was a question about HR 4329, which of course we all know because we're all experts on the U.S. legal process.
Right, yeah.
So it's a bill in the U.S. Congress about mandating ESG disclosure. I'm not going to speak about any particular UN member states' legislative process before it's run its course, but one of the things I would like to say is a trend line here. Again, on the SSE website, one of the data points we track is the number of exchanges that are subject to mandatory ESG disclosure. Currently, that number stands at 24. If you roll back the clock 10 years ago, as we all said that we've been working together so long, back then that number would have been less than 5, probably around 2 or 3. And there's been a huge surge just in the last 5 years. So I think the world is on trend by 2030 in time to achieve the Sustainable Development Goals of this becoming, ESG disclosure becoming mandatory in many markets, if not most markets around the world. And it's useful for exchanges playing a very strong role in educating markets about practices that may become mandatory in the future.
Anthony, thank you. And in view of the time, I don't think we have time for lightning strikes from everyone else, unless you make it 10 seconds genuinely. David, you look disappointed.
Well, there's a number of questions on regulation, as Anthony picked up. I think we saw big announcements just last week from the UK government, which based TCFD reporting, so very kind of global, links up that we want to see more globally consistent approaches, also work on taxonomies, which is going to be a really important future area. But we need regulators, policymakers to be working together. We want global frameworks. It's not helpful if they all go for different directions.
One day, 10 years ago, we needed them to take action. Now they're taking so much action, we need more coordination. It's great that they're taking action. Thank you, David. Any other last comments from Michael or Shamila, or can we wrap up the session in a timely fashion? Thank you both very much. So all of my fellow panelists, with huge thanks to Shamila, David, Michael and Anthony, particularly Anthony and Michael for convening CDSB and SSE convening this particular webinar. It's all part of London Climate Action Week. I hope you enjoy the rest of the week. And what we look forward to is Mark Carney taking this guidance into COP26 so that it will ultimately achieve greater measurement of the problem and greater alignment of exchanges and how it gets managed, and ultimately more action, which will drive down the parts per million of CO2 in the atmosphere. Thank you all very much indeed for participating, and thank you all for dialogue.